Welcome to the Financial Freedom Mastermind Group podcast. Here we're all about breaking free from the 40 to 50 year work grind and accelerating our journey towards financial freedom. Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence. We serve as a hub for connecting with fellow members during our sessions so you can share successes, ask questions, and keep the momentum going.
Good evening, everyone. This is Niyi Adewole, host of the Ekabo Home Financial Freedom Mastermind Group. I'm excited today to be joined by Laura, who is a private wealth advisor. And I'm not going to butcher her last name. I'm going to let her say her last name, but she's a private wealth advisor that has also written books and helped countless individuals get closer to financial freedom, which is what we talk about on here on a daily basis. And so, Laura, I'm so excited to have you join us here this evening.
Thank you. It's really good to be here.
Of course. And could you help me with the last name? Because I did not want to butcher it.
It's one of those funny names that if you see it in print, you don't know how to pronounce it. If you hear it, you don't know how to spell it. So I get it.
Come on now. Hey, and you were spot on. And my name is similar.
Yes. And my practice name is Impavid Wealth Advisors. There's a story behind that. And Impavid is a little known adjective in the English language that means fearless. Fearless. Hence my book, Fearless Finance. So little tidbit for you.
I love it. And it's all congruent and kind of matches together. And you're spot on. Once you hear these things, it's a lot easier to kind of engage and bring it in. And one of the things I always like to start off with is, how did you even get down this finance path? Was this always a passion or did it collide with you at some point?
It collided with me. And that's a good way to say it. I grew up in rural Michigan and my mother died when I was age 12. And so at 12, I was sort of thrust into the role of, taking care of the household budget. My dad came home a couple times a week. It was like, here's car keys. Shh, don't tell anybody. Here's car keys. Here's a checkbook. There's, go to the corner store for groceries. And so from a young age, I learned about budgeting and handling things. But I also saw families growing up in that rural Michigan area that struggled financially and were college educated, great people that just struggled in that area. And so I grew up differently with a different relationship to money. And so as I graduated college, I saw the financial industry. It appealed to me because you were helping people. And at that time, because I've been doing this 30 years, there was a definite lack of women. In fact, in the area that I was at geographically, it was predominantly middle-aged white men. I could say that because there was lack of diversity. And so I could see a niche for myself. And so that's kind of how it all started.
Man, and first and foremost, sorry for the early loss, but it looks like you didn't use that as a crutch. You actually used it as something to kind of push you toward being able to help others that may find themselves in similar tough situations. And when you look at just your experience, right, you've had 30 years in this industry. One of the things, especially in the market that we're in right now, a lot of people are feeling like, man, there's never been anything like this. This is the first time this is happening. But for those that are historians or look back, nothing's ever really new. And so what do you think from this market compared to other years that you've seen in your experience?
This is very simplistic. What goes up must come down. We all know market goes in cycles. But what I would propose to you is what I tell my clients. What if I say that the biggest risk to your financial security and financial future is not the risk in the market? It's other things. And I say that knowing that we are bombarded 24/7 with tidbits and sound bites about the market and investments. What did the market do today? Is it up? Is it down? What's the latest crypto to buy? Who cares in the short run? Because there's more to what people need to look at, if that makes sense. And I meet in the 30 years I've been doing this, I have sat across the table from so many highly educated, highly successful, wealthy individuals that have anxiety and nervousness over their situation. And you look at them and go, wow, you've accumulated money. Why are you nervous? Do I have enough? My parents are getting older. I have to care for them. I've got kids in college. What if my spouse dies? Somebody got laid off from a job. The risk isn't always the market. It's one risk, but it's not necessarily the largest risk, in my opinion, which is why I wrote the book, Fearless Finance.
Absolutely. And one of the risks that you just mentioned that I think is becoming more and more apparent for people is that job risk, right? And for our audience specifically, we believe with the Financial Freedom Mastermind Group that we're not put on this earth to work, 30 to 4 hours per week, 30 to 40 hours per week for 30 to 40 years to hopefully retire. We try to get it done a lot earlier. And now with the advent of AI and companies now coming out, and instead of being, having not shame, but instead of it being a sign of weakness for a company to lay off 4,000, 5,000 people, it's now getting rewarded in the market when they bring up the terms, hey, AI is replacing all these jobs. And so when you look at that risk, that's a real risk in the market. How can people hedge against that?
Some of the things that I say in the book will take people back to the basics. And the first thing, or one of the first things I tell people is measure your money against the job it needs to do someday. Sounds pretty simple. However, if you don't measure, like if you're 40 and if you don't measure how much money you need for your lifestyle and what you want to do when you're 50, 60, 70, whatever the age is, and factor in taxes and inflation, how do you even know how much you need to have? You don't. You're only just sticking your finger in the wind. You don't. And that's where people get anxious because they don't always know how to do the math. They don't have clarity around that. And so if you have clarity around what you might need someday, then you can look at what kind of job do I need? What does it need to pay me? How much do I need to save? What if I lose my job? Things like that. If you understand your personal situation to know what your committed bills are, your discretionary bills. If you unfortunately lose a job, you know how much you can pull back on your expenses, all at the same time knowing how much you need to continue to build or what type of job or income you need to look for to replace what you lost.
Absolutely. It makes plenty of sense. And to your point, one of the things that you mentioned in the book was how people are using bad math and they may not know it, and it is hurting them secretly of their retirement. And so what did you mean by that? And how can we avoid that mistake?
I don't know where I came up with bad math, but I came up with it eons ago. And my significant other, every time I say bad math, he's like, would you stop saying that? I'm like, it's bad math. And I don't mean that people can't do math. I work with a lot of really smart people. They can do math. What the problem becomes is they want to avoid it and not address it because they're afraid they don't have enough, or they're afraid they're not on the right path, or they don't have the tools to run the number. It's not that they really can't do math. So for instance, when I run the numbers, I can literally project out how much you need to accumulate. So that way, when you get to retirement, how much money do you need year after year after year, factoring in inflation and taxes, and show those projections of what needs to be coming into your situation for you to be happy and have the money. So then back those numbers up to how much do you need to set aside. That's the math that a lot of people just don't have the tools to do, which as an advisor, obviously I have those tools.
Absolutely. And it's one of those things where, especially for those that are new to maybe that corporate environment and workspace, it's kind of intimidating. Right? I remember when I first graduated college, I moved into a medical device sales role for a healthcare company and moved to Chicago to join that company. And they were like, hey, you got all these benefits. You got this 401k and you got healthcare, you got everything else. And we're going to have a company match. And I had no idea, what am I supposed to do with this 401k? They had like 30 options. I'm like, listen, the way I ended up figuring it out was pulling one of the finance guys aside for lunch and saying, hey, I'm going to pay for lunch, but I need you to explain all this. And they ended up putting me in like a target fund, which now looking back, knowing what I know is good, but maybe not the most optimal. But for those just getting started, how do you not just get analysis paralysis when they throw all these options your way?
You do. And what I find with people and their 401ks, especially if they don't really have that plan and they really haven't mapped out the numbers, they either put it in a target date fund, which is not, I don't love, but I don't hate. It's because it's done for the person. And if you don't know what you're doing, or if you don't know where to start, it's a good option. I either find that, or people just randomly pick stuff. And I'll go, how did you pick this? Well, it did good last year. Okay, that's probably not a good way to pick the investments in your 401k. Let's talk deeper. And it's, people are not experts in investments, but they're left to their own devices with their 401ks. And over your lifespan, your 401k most likely will become one of the largest assets you have. I would argue to back you up a moment. If you're able to do the appropriate math and learn how much you need to save and how much you need to accumulate, that can actually help you as you're young in your career to determine what do you want to go after. What physicians do you want to target that will pay you what you need for what your goals are? Because sometimes people can't accumulate the money that they need because they don't get paid enough. So if you can pick a different career path or a different path within your corporation, that can help you with the financial freedom.
Agreed. And I think what you just said there is super important, right? Is
Mhm.
understanding that even in certain roles, you may not have enough to be putting aside. And so the goal should be, at least in my mind, focusing on becoming the best at that role so that you can move up to another role where now you can take that delta of the increase in pay and now put it toward that future, as opposed to what a lot of people do is start to live an even more absorbent life, right? Just delay gratification a little bit. And that delta can help you achieve your financial goals a lot quicker than you think.
I see so many different types of scenarios in the course of the time that I've been doing this. And I see people that it's constantly keeping up with the Joneses or the instant gratification, and they have all the stuff. But then when you look at the numbers, you're like, you're nowhere near on track. Bad math, because they don't want to look at it. They want to avoid it because it's better to buy that new pair of Air Jordans or the new purse or whatever than it is to save it for 20, 30, 40 years down the road, whatever. And then I see the other way where people are looking at their numbers and what they need, and they're diligent and they're saving and growing.
And I've seen in just the people that I talk to on a day-to-day basis, two types of people. There's those that are exactly like you said, they've never checking it, kind of flying by the seat of their pants, hoping that it all just takes care of itself. And there's others that are checking it every day and maybe starting to try to make moves like, oh, this went down, let me shift it over here. Oh, this is going up, let me shift over here. How often would you say we should be taking a look at this? And more importantly, how often should you be taking action after you've set a goal and put your whole plan into place?
It's most important to have the numbers of what you need to do. Once you have that, then it's important to craft the appropriate investment diversification for you. And without going too deep in that, because everybody's situation is different and everyone needs are different, but you need to craft the right asset diversification. If it is money that you're going to need in the next 2 years, 3 years, 4 years, it shouldn't be in the market, period. If it is for 5 years, 6 years, 10 years, 20 years, if the market goes haywire and you make a knee-jerk reaction, why? If fundamentally that investment that you're investing in works for you in the long run, if we hit the skids in the short run, why are you doing something? There was a study published by a financial firm, I forget who it did, that looked at the behavior of investors. Investors who don't work with an advisor or don't have guidance and do their own thing are less likely to be successful. And that really goes back to the emotional aspect, because money is emotional. It's tied to our dreams, our hopes, our fears. Money is extremely emotional. And when the market goes crazy, your first inclination psychologically is, I gotta sell, get me out of it, get me out of it, get me out of it. Stop. And so people that look at things every day need to get hobbies or do something different, because it's not really going to help you if you've crafted and built the right allocation for yourself. You have to stick with it. If you haven't crafted the right asset allocation for yourself, that's a whole different conversation, and you should do something.
I want to talk about a bit of an alternative asset and get your take on this, because a few years ago, this is an asset that, was kind of sworn off, but now becoming more in the mainstream, and that is crypto. Right. And you mentioned not looking at things as they're going up and down. I know in recent weeks, crypto has gone from a high to almost cutting in half. And this, from what I hear, is pretty normal for that. But what's your take on those type of assets within a portfolio?
What I will say about crypto, without making any recommendations one way or another, it's like a bunch of teenagers playing with matches in your garage or in your attic. People love it for a number of reasons. But one reason that I hear is like, oh, it's not regulated and whatever. I can't tell you the number of people that I have spoken to that have crypto and say, yeah, I had X amount in crypto. Someone got in my account and stole money. I've heard it over and over and over. And I'm like, well, what are you going to do? It's the name of the game. And it's extremely volatile. It's extremely speculative. So if you have money that you want to gamble, and if you lose it all, you're okay with that. Okay, then maybe research it and maybe take that on for yourself. If it is money that you are not willing to lose it all, I would say I would not tell my client that they should consider, because it's like the wild, wild west.
That's more than fair. Yeah, and it's one of those where even for some of the members of the group that are investing in there, we advise them, hey, less than 10% of your overall, really make it more closer to 1%, and you should be fine.
What I find over the years is that everyone's always looking for the hot stock tip or the things that's going to get them rich. They want the easy way out. I would like to take a pill that would make me lose 20 pounds, but that's the easy way out. They're always looking for the hot stock tip that all of a sudden they're going to be like multimillionaires and they've invested $50. That normally doesn't work with most people. I worked with a gentleman a long time ago, back when the tech bubble burst, and he came in, he's like all proud of himself, and he invested in some company. I don't even remember. It's been so long, I don't even know what it was. He invested in something and it was so millions, and proud, like, look at what I did. And I'm like, would you get out of it? No, this is the greatest thing since sliced bread. Well, he lost it all. And I'm like, but you feel good riding it up. You have to understand all that's really speculative. Is that going to build you the foundation to provide you stable retirement income throughout your lifetime? I argue that the answer is no. And so the people that I see that are successful in getting clarity and knowledge about what they should or shouldn't do in their situation, it is basic information. It is boring. It is don't take knee-jerk reaction. It is build brick by brick by brick. And if you want to have a little bit that's like, I'm going to gamble and play with this over here, and if I lose, that's fine. But the core piece, build brick by brick, whether it's, investment assets, real estate, whatever, that's how you build wealth over time. But you can't forget all the other risks that people don't want to think about, or they don't know to think about. Inflation, obviously we all know that, especially now with prices of goods, right? But imagine 30 years from now, 25 years from now, the price of what things might be. I could admit I've been around a little bit. I remember as a teenager, gas at 97 cents. I can't imagine 97 cents today, right? Inflation, how is that going to impact what you need? People don't think about that. What if you need long-term care in the future? And for many people, that is so far down the road, can't even think about it. However, if you don't build things in and strategies, you can have all the money in the world and you'll go bankrupt if your health takes a turn, healthcare in general. So there are risks that people need to look at as they incorporate it with their investment. Because if you're just buying the hot stock or the hot crypto or the hot whatever, and you ignore this other stuff, something is going to blow up in your situation because bad math, you haven't evaluated it and looked at the risk you're assuming.
Absolutely. I 100% agree. I think it's one where you've really got to, because nobody's going to save you when it comes to personal finance. It's personal. Like, you've got to dig into the numbers and understand where your dollar's flowing, because unless you direct it, they will flow out of your pocket, and you'll look back at the end of the year and be in the exact same position you were in before.
Taxes. How do you know what tax bracket you'll be in down the way? How do you structure between tax-free, tax-deferred, and taxable? That structure makes a huge difference. So how do you factor that in? So there's all these different pieces and parts that I will argue investment risk is not, the risk of the market is not the biggest risk. It is a risk, but not the biggest.
If somebody is listening to this and they're getting, kind of that rude awakening saying, hey, I haven't looked at my statements in forever, I haven't really put together a plan for the future, and I'm kind of just winging it, what would be the first step you'd recommend that they do?
Well, that's easy. The first step is send me an email and ask me for my book. I have boiled the book down to several basic things to continue to go back and evaluate in your situation. And it doesn't matter if you have 50,000 saved up, $500,000, or 50 million. It goes back to the same concepts. Measure your money against a job it needs to do, because the job will change. If you're 25 or 30 and buying your first house and you're not married, that's a different scenario than if you're 45 and you've got your second house, 2 kids, aging parents, maybe kids headed to college. Your math has changed. Do the math again. And I also tell people that work with me, throw it in a pile. Like, throw everything in a pile. Because sometimes people, they don't know what they have, or they don't know how to read it, or they're just like, I have this stuff. What do I do with the stuff? Throw it in a pile and let the professional, me or whoever you work with, look at it and sort through it for you. I have had a number of occasions where clients will call me and just like laugh, and I'm like, what's going on? And they're like, we got something in the mail. We didn't know what it was. We opened it. My husband has a 401k that he forgot about 10 years ago. It's hundreds of thousands of dollars. And I'm like, oh, that changes your plan. And they're like, yes. They forgot about it because they would just get the envelope and they just throw it off to the side. They never opened them for a decade. So just throw it in the pile so you can evaluate what makes up your situation. And that will change over the decades.
And literally what you just said is the piece that a lot of people miss. It's not investing for the short term, 1, 2, 3, 4, 5 years. It's investing in something that you can not look at it for a decade, come back and compounding interest has just done its work over time. And that's how you can get wealthy.
Correct. And you need to do that every so often because you'll forget about stuff. You get busy in your life. Maybe you're not the expert in investments and you don't need to be. Throw it in a pile and reevaluate it. Or you might realize, well, I have this 401k out here and I have this account over here, and you have it all mentally, but you've never really put it all together and looked at how much does it add up to, or what is the overall diversification when you lump it together. And there's things like if you have old 401ks, God forbid, knock on wood, what if something happens to you? Have you updated your beneficiaries? The number of times I hear stories of somebody got divorced or whatever and forgot to update the beneficiary. Somebody got married and forgot to update the beneficiary, and the money went to the ex-spouse, or the money went to somebody it shouldn't have gone to because they forgot, because it was somewhere else and it wasn't something they reviewed all the time. So there's other risks that would completely wipe you out that you have to look at. And it's not just, what am I investing?
I think you're spot on. And it's one thing that a few years ago, my wife and I actually started doing because we wanted to get really intentional before we started our family. And that was every month, once a month, we do a financial date, right? Like a financial date night. And we pull up our little spreadsheet and we actually go through it and update all the numbers for the real estate that we have, for the 401ks, for the actual cash, and any other type of investments. And it's helped us even in our goal setting. Every year we set a net worth goal, combined net worth goal, and we work toward that, which is a combination of paying down debt as well as acquiring maybe more assets or just putting more money into these type of accounts where it can grow over time and see that benefit. But it's crazy. What you focus on actually starts to grow. And so when you just put that attention to it, right, you start to look at the actual accounts, you're not going to make the mistakes that Laura's talking about where you're forgetting about the beneficiary being updated.
That is an amazing thing for you to do, and it is so smart. I have a couple that I've been working with for a while, and they kind of each run their own budgets and have their own expenses. And like, this spouse is, responsible for this much stuff, and this one's responsible for this much. And when I asked them, like, how much are you spending? They could never really give me good data. They finally got organized and found a program that worked for them. And they told me they spent, like X. And this was the goal of what they are spending. And I look at their numbers and they're spending like $30,000 a year more than what they think they spend, because this is the first time they sat down and filled the number. And so they are so close to retirement that they've actually said, we're saving as much as we can possibly save. And they really are. They need to sit down and figure out what is their money going to grow to and how much that's going to kick off to them so they can figure out what their lifestyle needs to be. I don't want you all to be in that situation where you've neglected it so long, you just have to live within whatever means your portfolio will give to you. So if you've got the time to focus. And if you sit there and say, this is overwhelming, get help. I mean, bare minimum, get my book and read it. And I think it'll help you, but get assistance and find an advisor that works for you. And not every advisor works in the same fashion. Some are comprehensive like me, that I look at all of this stuff, estate planning and taxes and cash flow and the whole 9 yards. There are some advisors that all they do are investments. And I don't necessarily think that's the greatest thing to do. But you have to find somebody you're comfortable with, that you can talk to, and you feel comfortable asking all the questions, even if you think they're stupid, because they're not stupid. But you have to have a relationship where you trust that advisor to give you the right guidance and help. And I think it's important, and not do it yourself. And I say that because it's the same way I would tell people, get a CPA, get an estate planning attorney. We can't be experts in everything. So you need those trusted people that you can rely on to get you over the finish line, whenever that finish line is and however you define it.
100% agree. It's one of those where the power of team will always beat the power of one, especially if you have a sharp team that's been working on this for their careers and that's what their focus is. And so I 100% agree. And one of the things that, it takes so much time to do, and we're so happy and thankful that you did it, but writing a book, right? You put together Fearless Finance, and now it's out and available for people to get and go ahead and read and start to learn about your story and learn how they can get their finances in order. But what spurred you to write this book now?
It is something that's been on my mind for a while. And I'm a numbers person. Like, I'm a numbers person. I work with people and build the relationships and help people get to where they want to be. I didn't know if I could actually write a book. I'm like, that's a whole different skill set. So it was my goal to do this last year, which I did. And there are capacity issues. Like, I'm one person. I have a team of 6. We can't work with 10,000 people. Like, there's a capacity issue. But I also know that people get bad information, or they're just constantly focused on the hot stock tip. And so I wanted to put a book together that has basic information that you can go back and refer to time and time again, because not everybody could get to me. And I personally chose the fact that I'm not selling the book because I mentioned my firm and I can't. We're in a highly regulated industry and I don't want to sell my book anyway. I'm not making money on the book. I want to get the information out there. So if somebody reaches out via email, sends me their name and address, I'll mail you a copy of the book. It's my version of karma out, karma back. And if I can help people that otherwise would never get to me, then maybe I can give them some good information that combats all this. Is the market up today? What'd the market do? Like, what does that really care in your personal situation? It cares if you shouldn't have money in the market for today. If it's money for 40 years or 20 years, it doesn't matter. Maybe yes, maybe no. So that's why I wrote the book, just to give good, solid information out there, regardless of your net worth or where you are in life, starting out or very close to retirement or transitioned into retirement.
I love that. And you're going to get probably your email blown up here because we're going to put it in the show notes so that
and that's okay.
Can message
this was my commitment to myself, because quite frankly, if there's a whole bunch of books floating around out the world, if people get good information from it and can impact their situation, fabulous. There will be some people that say, wow, that helps me. Maybe I should talk to her. That's okay too. So it's just my karma out, karma back, truly.
It's amazing. It's honestly amazing because it actually costs you money to send these books to people. So that's pretty incredible. And we're definitely going to push that to our audience so that they reach out to you and they can learn more about how to get their finances in order. What are you most excited about next? Like, I know writing a book is a tough endeavor, especially when you're still helping clients actively. And now you got to put aside even more time to do this. But what projects have you most excited heading into 2026?
Oh, I think that's the hardest question you've asked me. I have another book that I'm percolating on. It will be harder to write, but there's another book in me, maybe. My practice is just in a good spot that next year is going to be just an explosion of what we're currently doing. I have a marketing person on my team now that we've added, and most advisors don't have that, which is AKA why I'm here on this podcast. And so we're just trying to get more information out to more people. So next year is just going to be more of the same, but we're on a really good path to help as many people as possible.
That's incredible. And the more people that we can help, what I love about this kind of talk and what you're doing out there, and the reason that we started the whole Financial Freedom Mastermind podcast, is to help more individuals become financially free, or at least financially sound, to where now they're not focused on, hey, I have to make money to feed my family for this week. Now they've got a runway and they can start to use that mental capacity toward maybe solving other problems in the world, right? It's hard to think about your neighbor and others if, hey, I got to put food on the table for this week, or I don't have enough for the future. And so it's incredible the work that you're doing. And I think the collective efforts of all those out there that are trying to help people get financially free will allow us to be able to solve some of the world's problems eventually. Laura, anything else that I'm missing here?
No, I just think it's so important to look at your numbers and figure out what you need, because what you don't want to happen is retire and then you run out of money. How are you going to go re-earn it or rebuild it when you're in your 70s or 80s? You're not. So you have to look at the math, not just investments.
100% agree. Look at the math and actually use that to guide your thinking. And so, Laura, we truly appreciate you joining us on the Financial Freedom Mastermind podcast. If people want to reach out to you, and we're going to put it in the show notes, but do you mind just verbally saying how we can get a hold of you?
The best way to request the book is to send an email, and the email address is impavidwealthadvisors@ampf.com. Ameriprise Financial, ampf.com. And if somebody wanted to have a talk or just call whatever with questions, they can reach out to my office. The phone number is 813-319-0011. But shoot me an email if you want a book. We'll mail you a book.
Come on now. Done and done. Everybody that's listening to this in the future, go ahead and hit Laura up. We're going to put the contact information into the show notes. And if you like this, please go ahead and leave a comment, share, and follow. And we look forward to bringing more guests like Laura on to share their story and help you achieve financial freedom in this world. Thank you, Laura.
Thank you.
Join us every Wednesday at 7 p.m. Eastern as we explore different types of investments that can fast track your path to financial independence.